David Rubenstein paid $1.725 billion for the Baltimore Orioles in 2024, $1.7 billion, and the team's books showed a loss last year. So here's the question nobody in the press asked out loud. How does $1 billion purchase generate over $100 million in tax savings while officially reporting losses? The answer is one accounting rule. Perfectly legal, almost never explained, and every major league owner in America knows exactly how it works. Ticket prices keep climbing, payrolls get squeezed, public money funds stadiums, and owners quietly compound wealth while the team cries broke. Today we pull back the curtain. 4 case studies, 3 visuals, 1 framework. The losses are real on paper. The wealth is very, very real in practice. Here's the first thing you need to understand about the Orioles deal. Rubenstein's group didn't just buy a baseball team. They bought a $1.725 billion tax deduction, and they knew that before they signed anything. The projection going into that deal was roughly $6 to $7 million per month in tax deductions for the next 15 years. That's not a side benefit. That's the first line item any private equity buyer models when they're looking at a sports franchise. The baseball is almost secondary. So what actually is this rule? It's called the roster depreciation allowance, and it lives inside IRS Section 197, which was enacted as part of the American Jobs Creation Act in 2004. What it says in plain English is that when you buy a sports franchise, you can treat almost the entire purchase price as an intangible asset. Things like player contracts, sponsorship agreements, luxury suite deals, the franchise license itself, and you can write that entire amount off as depreciation over 15 years. About 100% of what you paid, spread across 15 years, deducted against income every single year. Now here's where it gets interesting, because this argument actually started in the 1950s with a guy named Bill Veeck, who owned the Cleveland Indians. Veeck convinced the IRS that professional athletes waste away like factory equipment. His argument was that a ballplayer's body depreciates just like a machine on an assembly line, so the cost should be deductible the same way. The IRS bought it, and that logic, with some modifications, still holds legal water today under Section 197. You're essentially telling the government that the thing you just paid $1.7 billion for is simultaneously losing value, while it's actually appreciating at 15 to 25% per year. That gap between the paper story and the real story is where owners get rich. Let me walk you through the math so this actually clicks. Pull up the accounting trick waterfall graphic here. Rubenstein pays $1.725 billion. You divide that by 15 years and you get roughly $115 million in annual deductions. At the current federal corporate rate of 21%, that's about $24 million per year in actual tax savings. Run that across the full 15-year period, and you're looking at a total tax shield of around $360 million on a single purchase. That's not a rounding error. That's a private island. And here's the mistake most people make when they hear the word depreciation. They assume it means the asset is losing value. It doesn't. The franchise isn't losing value. It's gaining value fast. What's depreciating is a number on a tax form. So while Rubenstein is writing off $115 million a year as a paper loss, the actual Orioles franchise is likely worth hundreds of millions more than what he paid. The paper loss and the real wealth move in completely opposite directions. So what does the public see? The team reports a $40 to $60 million operating loss. That gets picked up by sports journalists who write about financial struggles. Meanwhile, the owner pays near zero federal tax on team income because the RDA deduction wipes it out, and the franchise is quietly worth $400 million more than on purchase day. The broke story serves everyone who benefits from it. One more thing before we move on. This only triggers on a purchase. If you grow organically, no deduction. So every time a franchise sells for a record price, and they always do, the new owner immediately gets to reset the clock on a brand new 15-year tax shield at the new higher valuation. The more expensive teams get, the bigger the annual deduction. So that's the trick on paper. But the RDA is just layer 1. The second layer is where public money enters the equation, and it's a lot bigger than most people realize. The RDA is a private trick. It happens between an owner and the IRS, and most fans never see it. But the stadium subsidy shuffle is different. because this one comes directly out of your pocket. In January 2026, the Kansas City Chiefs secured $1.8 billion in taxpayer funding for a new stadium. That's the largest public stadium commitment in U.S. history, for a franchise currently valued at over $5 billion. Let that sit for a second. A $5 billion business, owned by one of the wealthiest families in professional sports, just got nearly $2 billion from Kansas City taxpayers. And the Chiefs aren't an outlier. The Bills got public support for their new stadium in Buffalo. The Titans did the same in Nashville. NFL owners have collected over $10 billion in stadium subsidies since 2010, while franchise values across the league have tripled. So how does public stadium money actually deepen a paper loss? Two moves, and they work together. Move 1. The owner lobbies hard for public bond financing. The city or state issues bonds. Taxpayers cover the construction costs, and the team gets a brand new stadium it didn't pay for. The owner contributes something, usually a fraction of the total cost, but the heavy lifting comes from public funds. That part everyone more or less understands, even if they don't love it. Move 2 is where it gets clever. The owner then takes on private debt at the team level, usually framed as funding for improvements, premium seating, technology upgrades, branding deals tied to the building. That private debt generates interest payments, and those interest payments are fully deductible against team income. So now you have a publicly funded stadium generating private revenue, with private debt layered on top generating private deductions. The taxpayer builds the asset. The owner writes off the financing. Pull up the paper loss versus true equity scorecard here. Look at the Bills. Look at the Titans. In each case, you'll see a reported operating loss sitting right next to a tax shield from interest deductions, sitting right next to franchise valuation growth that dwarfs both numbers. The red ink on the income statement and the green equity appreciation in the private books are telling two completely different stories about the same business. And here's the belief breaker that should actually make you angry. The teams crying loudest about needing a new stadium, the ones threatening to relocate, the ones sending lobbyists to City Hall, the ones running local press campaigns about economic impact. Those are almost always the franchises with the fastest valuation growth. The "we need public help or we can't survive" narrative isn't a financial reality. It's a negotiating strategy. The broke story is the leverage, not the truth. Because once the stadium gets built, the owner's equity position improves dramatically. A new stadium raises the franchise's market value, increases premium revenue streams, and gives the next buyer a higher purchase price to depreciate, which resets the whole RDA clock again at an even bigger number. Every publicly funded stadium is essentially a gift that keeps compounding in private hands. The RDA creates paper losses at the moment of purchase. Stadium debt deepens them over time. But there's a third force hitting right now in 2026 that's handing owners a brand new excuse to cry poverty, and this one is collapsing in real time, loudly, in bankruptcy court. Regional sports networks were the invisible money printer behind professional sports for 30 years. You probably never thought about them much. They were just the channel your cable package included so you could watch the local team. But behind that channel was a financial arrangement that pumped tens of millions of dollars per year directly into team revenues. No tickets sold, no merchandise moved. Pure carriage fees. At peak, cable providers were paying $2.50 to $3 per subscriber per month just to carry these networks. Multiply that by millions of households across the market, and you're talking about a $40 to $80 million annual revenue line for a single team, basically on autopilot. That machine is now on fire. Diamond Sports Group, which operated the largest portfolio of regional sports networks under the Bally Sports banner, filed for Chapter 11 bankruptcy in March 2022. When they filed, the books listed $8.8 billion in assets and $4.3 billion in liabilities. By 2026, preliminary bids for the entire DSG portfolio were coming in between $200 and $500 million total. The peak valuation on those same assets was $8 to $10 billion. That's a 95% wipeout in roughly 4 years, playing out in open bankruptcy court where anyone can read the filings. And in January 2026, 9 MLB teams terminated their RSN deals after Diamond's successor, Main Street Sports, stopped paying the contractual guarantees. Tigers, Braves, Reds, gone overnight. Each of those teams is now looking at a $40 to $80 million hole in their annual revenue, and every single one of them has been very vocal about it. Payroll constraints, ticket price adjustments, difficult decisions ahead. The narrative writes itself, and the press runs it without much pushback. Here's what the press usually leaves out. Carriage fees didn't just shrink, the whole model was already dying. US pay TV subscribers dropped from roughly 100 million in 2010 to around 60 million by 2025, according to Leisman Research Group. The fees per subscriber fell by more than 50% since 2021 alone. Diamond didn't create this problem. They just borrowed $9.6 billion to buy into a collapsing model and ran out of road. The RSN crisis isn't a surprise that hit teams without warning. It's a slow structural collapse that owners watched develop for years, while quietly working on the replacement. That replacement is direct-to-consumer streaming, and it's where this story flips. MLB assumed production for 12 Bally Sports teams in January 2026, absorbing broadcast infrastructure at distressed prices. The Minnesota Twins launched a direct streaming app that hit 500,000 subscribers in 2025. When you cut out the RSN middleman entirely, the margin structure on media rights improves dramatically. No revenue split with a cable operator, no carriage fee negotiation, direct relationship with the fan, higher long-term value per subscriber. The RSN collapse isn't destroying team media economics. It's clearing the way for a vertically integrated model that leagues will own outright. Pull up the owner cap table graphic here. The franchises posting the loudest RSN-driven losses, Tigers, Braves, Reds, are sitting on Sportico valuations that keep climbing regardless. The Braves' parent company Liberty Media trades publicly. You can literally check the stock price. The reported media losses and the underlying equity appreciation are moving in opposite directions, exactly like the RDA story in Section 1, just with a different villain on the press release. The RSN crisis is real, the revenue hole is real, but it's also temporary, and the owners know exactly where this ends. Now let's cross the Atlantic, because European clubs have been running a version of this same playbook for years, except their regulators actually tried to stop it. UEFA introduced financial fair play rules to solve a specific problem. Rich owners were buying clubs, absorbing massive losses, and outspending everyone else by treating their football club like a hobby rather than a business. The rules said, roughly, that clubs couldn't spend significantly more than they earned. Losses above a certain threshold triggered sanctions. The idea was competitive balance, stop Roman Abramovich or Sheikh Mansour from just printing trophies with private money. It didn't work. And the reason it didn't work is the same reason the RDA works so well in America. When you give sophisticated owners a clear rule with a hard number attached, they don't stop spending. They hire accountants. Here's the core loophole, and once you see it, you can't unsee it. If your club is approaching the loss threshold, you need to book more revenue. But you can't conjure real revenue out of nothing unless you control other businesses that can pay your club for things. So you sell assets to related parties at inflated prices. Your owner's hotel chain pays the club for sponsorship rights worth 3 times market rate. The women's team, which the owner also controls, buys something from the men's club at a price nobody independent would ever agree to. A real estate company connected to the ownership group purchases naming rights. The transactions are real on paper. The prices are fiction. The club's revenue goes up, the reported loss comes down, and you stay compliant. Chelsea ran one of the most technically sophisticated versions of this. Their approach combined 2 things: multi-year amortization of transfer fees spread across the length of a player's contract, structurally identical to what the RDA does with intangibles, plus a series of asset transactions with connected entities that booked revenue at valuations. UEFA later scrutinized heavily. Chelsea were fined by UEFA in 2025, so was Aston Villa. The fines were real. They were also smaller than the competitive advantage the spending created. When the penalty costs less than the prize, the incentive to comply weekly is built into the math. UEFA's 2025-26 rules now explicitly ban self-dealing between connected parties, closing the most obvious version of the loophole. But closing one door rarely ends the game, it just moves it. The underlying structure is unchanged. Clubs need to report acceptable losses. Owners want to spend more than revenue allows, and there's always a gap between what the rules say and what a creative transaction can make the books show. Pull up the paper loss versus true equity scorecard for the Premier League here. Arsenal, Chelsea, Manchester City. In each case, reported club losses sit alongside owner equity appreciation that tells a completely different story. City's parent group, CFG, owns clubs across 12 countries. The value of that network doesn't appear anywhere on Manchester City's UEFA compliance filing. Arsenal's Kroenke ownership stake has appreciated by billions. The losses the clubs report to regulators and the wealth the owners are building in private are moving in opposite directions, just like the Orioles, just like the Chiefs, just like the Tigers. Different continent, different rulebook, identical playbook. Pull up the full accounting trick waterfall now, because this is where everything we've covered snaps into one picture. Layer 1, the RDA deduction. On a $1.725 billion purchase, that's $115 million per year written off as a paper loss. Layer 2, stadium debt interest. Private financing layered on top of a publicly funded building, fully deductible, deepens the reported loss by tens of millions more. Layer 3, the RSN shortfall. 9 teams posting $40 to $80 million revenue holes in January 2026, each one a legitimate-looking line item that makes the income statement look worse. Layer 4, FFP asset shuffles on the European side. Revenue booked through connected parties, compliance maintained, competitive spending disguised as balance sheet management. Stack all 4 and you get a reported operating loss of $50 to $100 million that the press dutifully covers every year. Now look underneath it. The tax shield from the RDA alone runs $80 to $150 million over the depreciation window, depending on the purchase price. Franchise appreciation compounds at 15 to 25% annually, a rate most private equity funds spend careers trying to match. The owner reporting a $60 million loss is simultaneously watching an asset grow by $200 to $400 million in the same calendar year. Those two facts never appear in the same headline. This is the screenshot moment. These teams aren't broke. They're tax-optimized cash machines. The losses are real on paper. The wealth is very, very real in practice. And the money is pulling in people who understand this exactly. Private equity firms, Arctos, Ares, Redbird, are flooding into sports ownership because they've run the model, and they know what they're buying. It's not a sports team. It's a hybrid structure that functions simultaneously as a tax shelter, a real estate play, and a media company, with the additional feature that the underlying asset almost never loses value and sells to the next buyer at a record price that resets the entire depreciation clock. No other asset class in private markets does all of that at once. So next time your team raises ticket prices or trades a star citing payroll constraints or lobbies City Hall for public stadium money, the question isn't whether they have money. The question is which accounting line they're hiding it on. Sports finance isn't about wins and losses. It's about depreciation schedules, debt structures, and equity arbitrage. And the people who actually run those models are among the most valuable employees in professional sports right now. If you want to work inside this system, the roles to target first are team CFO, director of finance, and private equity sports analyst. Those are the people building the RDA models, structuring the stadium debt, and negotiating the streaming transition deals. Get into those rooms and the sport becomes secondary. The skills that get you there, forensic accounting, Excel depreciation modeling, a working knowledge of IRS Section 197 intangibles, and the ability to read a bankruptcy court filing without flinching. The Diamond Sports dockets alone are a graduate-level case study sitting in open court records, free, detailed, and almost nobody in sports business has actually worked through them. The data sets to master are Forbes and Sportico valuations, league profit and loss leaks, stadium subsidy trackers, and the KPIs that actually matter. Adjusted EBITDA before RDA, tax shield as a percentage of purchase price, equity appreciation versus reported losses. Next time your team says it's broke, check the tax returns. The real game isn't on the field, it's in the footnotes. If you want to understand who's actually winning that game and how private equity is rewriting the ownership rules across every major league, that's exactly what we cover in the next video.